Good afternoon and welcome back to the Money, Metals, and Mining Virtual Expo. First off, I want to start by thanking our speakers, sponsors, media partners, and most importantly, our viewers for not just joining us today, but also patiently waiting for Lynn. Now, for a quick reminder, for the best experience, make sure you close all your computer resources by closing any program you're not using. That way, your computer resources are freed up. And if for any troubleshooting issues, please refer to the frequently asked questions by clicking on the question mark at the top of the virtual platform. Now I'm excited to introduce our speaker, Lynn Alden. Schwartzer is the founder of Lynn Alden Investment Strategies and is a contributing analyst to ElliotWaveTrader.net, covering equities and alternative investments. With a background blending engineering and finance, Ms. Alden blends fundamental research with a global macro overlay to find opportunities in markets around the world. With that being said, please type any questions you may have in the chat box. Time permitting, we will be happy to answer some of your questions at the end of the presentation. Lynn, thank you so much for joining us today. The floor is all yours.
All right, thanks for having me. I'm going to bring up my presentation here now that we can go forward. Okay, so what I want to talk about today is basically, as it relates to gold, I'm going to talk about the U.S. Treasury market and some of these structural problems that are happening there that should, over the long run, contribute favorably to gold, as well as some kind of, competing assets like Bitcoin and things like that. But gold is currently the much larger market, and that's what this is focused on. So, if you look over the very long term, this is a chart of annual deficits year over year in the United States. And it's kind of a funny chart because obviously you have, you can't even tell the differences in these years, although some of the differences were quite big because due to inflation, due to the denominator currency going down so dramatically, we only started to see deficits here, really after the gold depeg. So basically you had a significant devaluation of the dollar and you had much less tethered financial responsibility. And as we can see, although there were highs and lows, it's a quite a structural degradation in overall deficits. This is a somewhat more helpful chart, although it doesn't have forward expectations like this does, and it doesn't go back as far. But this shows the government surplus or deficit as a percentage of GDP. Or as a ratio to GDP. So right now it'd be at 11% as far as the latest year's reading. This lets you see some of the differences throughout this period. So it's less comical than this one, and it gives you kind of a better snapshot of how things are relatively. One thing to keep in mind about this period, this was an unusual surplus in the post-1971 environment, and that coincided with a couple things. One is you had the demographic peak in the United States. You had baby boomers reaching kind of the peak of their careers, full in the workforce, and you had the explosion of internet productivity, the dot-com bubble, so rising equity prices. And if you look at U.S. labor force participation, that's when it reached its peak, right? So you had over the highest the labor participation ever reached right at this point, right? And so ever since then, as demographics have aged, as you've run into other problems, we've rolled back over into deficits. So this really was the anomaly here. And for the most part, it's the structural downward trend. Another way to look at it is that you can compare the unemployment rate, which I have here in red and it's inverted, to deficits as a percentage of GDP. And as you can see, as one might expect, there's a very strong correlation, right? I mean, they're generally going up and down at the same time, more or less, because stronger economies, you get better tax revenue, weaker economies, you get weaker tax revenue, and then sometimes you have some sort of stimulus. And so you have larger deficits when unemployment is higher for multiple reasons. You had a handful of times where it was different, right? So this was a decoupling, and this was related in part to the Vietnam War. That was kind of the significant reason. You also had significant domestic programs, but for the most part, there's a strong correlation. One thing I started to watch back in 2017 or so was this persistent decoupling, right? Where you have unemployment rate kept going lower. Remember, this is inverted. So unemployment rate kept going lower, but deficits, after improving from the global financial crisis, started rolling over. And why was that? So it started in 2016, and a lot of it was just demographics. More and more baby boomers were entering retirement, and therefore, rather than contributing tax revenue, they were then going into Social Security. They were withdrawing basically the savings they had built up, and so you had the whole system became more and more top heavy, and due to the way it's structured, it just started to become more deficit focused. In addition, in 2017, well, early 2018, really, you had the Trump tax cuts. You cut corporate tax rates, you cut income tax rates to some degree, and these were not offset by spending cuts. And so you just added. It was basically a fiscal stimulus. You added to the deficit. So there are both demographics reasons and tactical reasons why we started entering a more structural deficit, despite the fact that unemployment was still improving until the whole COVID fiasco. And so this is interesting, and this is contributing to why it's just in a structural downward slope. Kind of a separate way of looking at this. This is the Social Security Trust Fund, right? So when Social Security, the way it operates is that a lot of taxes go in, and the surplus is saved in treasuries. These are special non-marketable treasuries. And they earn interest, and then they also just to save what they're accumulating. And so, for many years, as the baby boomers, enter the workforce, you had this big demographics bulge, you had a lot of productivity, you had excess savings. So more was going into Social Security than was coming out. And in recent years, that's been kind of topping out. And just over the past year, you've had the first major decline. And it's projected currently, and this changes year to year, but it's currently projected that by the mid 2030s, this will be entirely drawn down. So it's going to draw down about twice as fast as it went up. So really, since the mid 80s is when this surplus started, and so you had 30 some years, and in less than 15 years, it's gonna go down to zero. And so what this essentially means is that in this environment, these are going to be selling their assets to the Treasury, and the Treasury is going to have to issue more normal treasuries in order to finance this. And if this, in the 2030s, if this hits zero, then essentially what happens is that either legislation has to come in and change something, or they would only be able to fund in line with incoming revenues. And so you'd have to cut payments by 20, 30% or something like that. But the point is, this was a huge demand source essentially for treasuries. And now it's going to start resulting in surplus treasury issuance, larger and larger deficits as more of these unmarketable securities are essentially exchanged for actual public treasuries. And this coincides with this decoupling where we have larger deficits, even when we're not in a recession, even when unemployment is getting better, we still have these structurally rising deficits. Another variable to consider is interest expense, right? So this is the absolute charge. So this is just how much annualized interest expense the U.S. government pays on its treasuries. And back in like the late 80s, you started to have a lot of concerns around debt, right? So that's when the famous debt clock in New York was put up. That's when you had Ross Perot run one of the most successful third-party candidates in U.S. history. He ran a significant part on fiscal responsibility because you had this huge uptick in interest expense. And they basically thought it was going to blow up in a few years. What instead happened was, because you had this great moderation of interest rates, and actually I'll go to my next slide. You had this structural decline in interest rates, and you also had that demographics peak I talked about in the late 90s, early 2000s. You actually had a multi-year, like a couple decade flat line of interest expense, and then only in recent years has it resumed this parabolic increase, right? So this lulled a lot of people. One, it kind of temporarily discredited people that were freaking out about the debt here. They were just early, essentially. So this gave a lot of people complacency of like, there's no problem with debt as long as the government issues its own currency, who cares? But now it's starting to get interesting again. Another way to quantify this, and probably a more honest way to quantify this, is interest expense as a percentage of GDP, right? And so that shows that it's not currently at the problem levels that it was, although this is backward looking, right? So, during this whole period, going to my next slide, you had rising interest rates. So you had larger debt and higher interest rates on the debt. And so you went from paying 2% of GDP in annual federal interest expense all the way up to 5%, right? And so, but during the structural decline in interest rates, from the Volcker spike up to super high levels, high teens, all the way down to very low levels, that reduced as a percentage of GDP federal interest expense. So you had rising debt offset by lower interest expense. And so you've kind of been in this like holding pattern around 2.5% of GDP for a while, or a little under 3%, maybe call it 2.7%. The problem going forward is that now that the Federal Reserve is trying to rein in inflation, trying to get back to positive real rates, while deficits, as the prior slide discussed, are like kind of completely out of control, this number is going to keep going up, as well as this is going to start rising again. And unlike this time, there's no demographics boom coming. There's no structural decline in interest rates coming. And so when you have that combination of higher deficits and then flat or upwards interest rates, that's when you start to get a fiscal spiral that in many cases resembles what happens to emerging market currencies. And on that point, I mean, so during the structural rise in interest rates, this was a very inflationary period. These high interest rates were often lower than inflation, and so you actually, from all the way back in the 40s, which is off this chart, kind of the World War II debt, a lot of it was inflated away because both in the 40s and then the 1970s, you had in many cases deeply negative real interest rates, and they were structurally reducing debt as a percentage of GDP, even though they weren't really running surpluses. They were just growing nominal GDP faster than the debt and faster than interest. And they didn't have like huge deficits. Starting in the 1980s, when they got back to structurally positive real rates, you started to get rising debt as a percentage of GDP. And then again, for this period of time, you had this demographics boom. You had kind of the peak US productivity. You had the dot-com bubble. You had baby boomers, maximum workforce, height of their careers, their peak earning years in like say their 40s. This was a unusually good period. But that period ended starting in the 2000s, and especially in the global financial crisis, when some of this was artificial and was kind of mark to market pretty quickly. We then stabilized again for a period of time, but then COVID and all that blew us out again. We're inherently a very fragile, indebted system, so when these shocks hit the system, things go vertical pretty quickly. When we look at the gold price, it's interesting. So in this period, after they stabilized, the 1970s was chaos for the dollar. It got so bad that under Jimmy Carter, they actually issued government bonds denominated in Swiss francs and German marks for a small period of time, because there was just so little confidence in the dollar. But starting in the 80s, when they solidified the dollar for multiple reasons, not just Volcker, but he was a big variable, you started to get you got a multi-year kind of plateau in gold, right? So gold was at a bubble peak in the late 70s, early 80s, and then for 2 decades, it essentially went nowhere, flat to down. And especially in the late 90s, during this demographics boom, people just completely lost interest in gold. Even central banks were selling gold. I'll actually jump forward to the next slide. This is central bank gold reserves, and it's by the world. This chart's by the World Gold Council. And from the 70s, you had the structural decline. The axis is somewhat misleading because it doesn't start at zero, but essentially you went down from 37,000 tons down to about 30,000 tons. You had a 7,000 ton reduction in gold reserves. And essentially what happened was the US Treasury replaced gold, or at least at the margins, as a reserve asset. But ever since the global financial crisis, there's been a reversal in that trend, which makes sense. And so essentially when you had this kind of environment with super confidence in the United States economy, super confidence in the US ability to service its debt, no interest in gold. But after the popping of that bubble, and especially with the global financial crisis, there's been, you had a significant increase in gold. Then you had this period of stabilization again, and you had this kind of period of stabilization in gold, which is to be expected to have such a parabolic increase. Then you had, as we started to roll over into recession in 2018, 2019, we had another uptick in gold interest that kind of crescendoed in COVID. And then we've kind of been in this like flat, choppy pattern. It's kind of been actually kind of disappointing. I thought we'd kind of be over 2000 by now, but essentially, you're at this kind of plateau. And I think to kind of to wrap things up, I think the thing to focus on is, this chart that, we had this constant period, multi-decade period of lower lows and lower highs in terms of interest rates. And now we're starting to break that pattern. The last time we broke that pattern was the 1940s, where you had, you went to zero interest rates during the Great Depression. And then you had huge inflation during the 1940s with all that fiscal spending associated with the war. And then you started to get this structural rise in interest rates, and a lot of the debt was inflated away. And we're kind of starting to mimic that now, where, we might or may not go higher, in terms of interest rates, but we're certainly not going lower. I mean, we're certainly not going to like -4, -5, -6%. It looks like interest rates are going to chop around sideways for a while we still, again, have these structural deficits that are completely unrelated now to the economic cycle, or at least, they're still related to the economic cycle, but they're deficits even during good times. And this is going to draw down. So this is all going to become publicly tradable. $2.9 trillion worth of non-market treasuries are going to essentially become marketable treasuries over the next decade plus. And so essentially what we're looking at is an environment where there's no clear solution out of this for the United States. They're going to have these structurally high deficits, with interest rates that are no longer falling. That means higher and higher interest expense relative to GDP. And so the end game is probably some degree of financial oppression, which is what they did in the 1940s, and what Japan's doing now, which is where they just do yield curve control, and they say treasuries have to trade below inflation. And that's very currency negative, and that's very good for hard assets. So that could be commodities, that could be gold, that could be Bitcoin, like basically anything that's scarce and desirable in various ways. You can kind of mix it out. But that's kind of my long-term thesis for gold, is that we're entering a period where this whole 40-year period of lower interest rates that helped offset the rising debt is behind us now. And so now going forward over the next decade, 2 decades, there's going to be very hard choices in terms of just, how to manage the U.S. fiscal position, while you probably have some degree of political stalemate, political uncertainty. And I think in the long run, we're going to find ourselves in a similar place as Japan, where they're essentially forced to, not have tight monetary policy, even when they would prefer to, right? So right now they're able to tighten monetary policy. This is a very short period of time. They're able to act tough. They're able to tighten. But then the question is, going forward, when you have this basically this massive structural deficits, it's very, very hard to maintain positive real rates in that environment. And so that's kind of like, grab your popcorn, grab your gold, and watch as this plays out. And I think that there's going to be a lot of opportunities to, in a risk managed way, be exposed to more hard assets, and be very cautious about owning large amounts of say, fiat denominated assets. That ends my core presentation, but I'm happy to take questions. Is the host still here?
Hey, Lynn. Sorry. Hello?
Yeah, hello. I'm able to take questions if there's any questions in the audience.
Yes, we do. So the first one that I have is from John. He's saying Damien said after the FTX and other crypto debacle that it was like pet rock market. You have been bullish on Bitcoin. Going forward, do you redeploy crypto holding gold?
No, I'm buying both gold and Bitcoin. I'm currently buying more Bitcoin because I view it as undervalued, but I own both, right? So I've been long Bitcoin 6,900. It went all the way up 10x to 69,000. It's gone down to 16,000 or so at the current time. I'm still structurally bullish. I'm bearish, however, on the broad crypto space. I think the vast majority of it is malinvestment. There's 20,000 coins. Most of them are unregistered securities. Most of them don't really serve a purpose. And so outside of Bitcoin and stable coins, I'm not really interested. And actually, I'm also deploying venture capital into that space. So I'm actually helping to finance companies that are building on top of the Bitcoin network, basically improving financial services around the world. And so that's where a lot of my interest is. But that doesn't change the fact that I'm also bullish on gold and many other commodities in this market as well.
The next question that I have is from Paul. He's saying, regarding worry that physical gold ETFs may not actually hold gold equal to the paper shares sold, is there a best choice among Aberdeen, Sprott, SPDR, and other offerings?
Well, so I personally view Sprott as the most trustworthy. Anytime you have a product that is technically redeemable, that's probably going to be a better bet. You still have custody and counterparty risks, right? So in this case, you're relying, I believe, on Canadian custody. And so you still have potentially forces outside of even Sprott's control that could in some way like impair those assets, right? So there's no perfect solution there, but among publicly traded baskets of precious metals, I think Sprott's probably the safest bet. I think there's really no substitute for having say physical gold coins or just other precious metal assets. It's either in your own custody to some degree, up to an amount that is reasonably secure, or relying on other non-bank custody services that you can access, right? So I think it's worthwhile to spread out your exposure to some degree, depending on how much you have, and balance that out in different ways. One of the, kind of the whole point of precious metals is that they are an asset that is not someone else's liability, right? So, most other assets, they're both an asset and a liability to someone else, right? So equities are the liability of the corporation, so are bonds. And obviously you can't really self-custody them. You hold them at a brokerage, you hold them in stock certificate form, you hold them in various ways, and you're relying on some sort of centralized issuer honoring that. And so that's one of the reasons gold is kind of a hedge against the whole global financial system, is that it's a bearer asset. If you hold gold coins in your own home or in kind of a nearby, safe location, you have a bearer asset that is not reliant on a counterparty owing you a liability. It's not a liability for them, right? And so I think it's worthwhile personally to have some degree of physical assets, and then up to the once you get to a point where it's no longer secure, obviously, to have too much in your own custody, that's when you can look into other things. And I do think that Sprott is probably one of the best risk reward securities when it comes to these publicly traded ones.
Next, Timothy says, hi, Lynn. In the short term, what do you see on gold and TLT?
So what right now we're seeing, so the Fed's been raising interest rates by 75 basis points per clip, and we're probably getting to the end of that period. So we're probably going to look at another 75 basis point increase, probably 25 after that. We'll see what happens. Things change. The big variable. So one of the big variables to watch is inflation, right? So inflation is still high, but it's rolling over from a high peak. And I think we're probably going to have future inflation spikes after this. But for the moment, the tactical moment, we are in a disinflationary period. The thing to watch is the Chinese reopening, which has kind of had these numerous false starts. But they're a huge source of commodity demand, especially energy demand. And to the extent that they open or to the extent that they do fiscal stimulus, they could really upset energy markets, right? I mean, they can get energy back into a rising price pattern if they really start consuming more. And so that's kind of a big variable, a big question mark to keep watching. I think, looking at the inverted yield curve, looking at the purchasing managers index, I think it points to significant possibility of recession in 2023. And so I kind of envision some of these longer duration yields to be, flat to down probably over the next year, as the global economy slows, especially the U.S. economy and European economies. But the wild card variable is that you can have a stagflationary environment. You could have China open up and keep energy prices high, and kind of mess with the disinflation that normally happens in a recession, right? So a lot of people are shocked by how poorly bonds did this year, despite the fact that the economy is slowing. And that's not common. I mean, that's not uncommon if you look at emerging markets. That happens all the time, right? Whenever you have an external liability, in this case, emerging markets often have dollar-denominated debt, or they need to import commodities while they have a currency problem. They often have a recession combined with inflation, right? And so the last time the United States experienced that was the 70s. Prior to that, developed world experienced it, during and after certain wars in the early part of the 20th century. And I think the 2020s are shaping up to be a similar type of environment. And so any sort of like quarter by quarter, year by year playbook is going to depend on these tactical variables. But I think the longer term thing really depends on commodity abundance or lack thereof, tight markets in this case, and these kind of fiscal spirals that the developed world finds itself in. So I think we're going to have kind of a stagflationary decade ahead of us.
The next question is from Miriam. She's asking, how high do you expect gold to go and when?
Well, I think I think the dollar is just going to keep, over the long arc of time. I mean, decade after decade, I think it's going to continue to increase in supply and decrease in price it's going to increase in supply at a faster rate than gold increases in supply. I mean, gold increases at a supply of about 1.5% per year. Dollars historically about 7% per year. And so I generally expect over the very long arc of time, gold to keep heading up. Although you can have these long stretches where it gets ahead of itself and then corrects for a period of time. So I think that $3,000 gold is certainly in the cards in many years ahead. And then there's no reason why it can't just keep traveling up from there, just not in a straight line, because it's essentially holding stable value. I think a more interesting way to look at it, and I think I've used these charts in prior Money Show presentations, you can denominate things like the median house price in gold. By that measure, gold's kind of moderately valued, right? It's not super cheap. It's not in a bubble relative to other assets like that. You can also look at things like the gold to oil price, which has kind of been in this big sideways trading range for decades. I think compared to those commodities, it'll probably keep holding up well, probably slowly appreciating against many of those other types of hard assets because it's got a higher stock to flow ratio. But in fiat terms, especially depending on what fiat currency you're measuring it in, I think over the long arc of time, those currencies are going to keep diluting the way they have been, possibly at an accelerated rate, and the gold is going to keep, decade after decade appreciating.
The next question that I have is from Paul. He's saying, if financial repression targets citizens holding gold, is possessing physical gold the only safe way to benefit from gold rising? Or are gold miners or royalty companies also safer than gold ETFs?
So I think it depends. So overall, I'm a little bit less concerned with government intervention and more just concerned with counterparty risk and the funds not having the physical gold that they say they do, right? So a lot of times they have paper exposure, and it's like a game of musical chairs. If the music stops, not everybody gets a seat because it's not really as much physical gold as people think they have exposure to physical gold. Back in the early part of the 20th century, the dollar was pegged to gold. And so you had, basically you outlawed gold ownership, and that was kind of this approach. Now gold's a really small market relative to total financial assets. And so financial repression can take other forms. It can take, they've already done it to some degree. Money markets have to hold more treasuries than they used to, for example. That's a very mild form of financial repression. Normally financial repression is kind of wrapped in a safety marketing thing, right? And usually has some degree of truth to it, right? So, for example, banks now have to hold more treasuries and just overall safe collateral than they did before the global financial crisis. That's another source of demand for treasuries. There could be mandates that pensions have to hold more treasuries or 401ks have to hold more treasuries. I think that's where the financial repression can take its form, as well as just central bank yield curve control like Japan's doing. I think that's where the core financial repression is going to be. And then it comes down to jurisdiction by jurisdiction nuance, right? So, could gold ownership be restricted or impaired in some way, especially these large funds of it? And I think that's certainly a risk to be aware of. And I think the lowest risk is to physically hold it. And then when it comes to ETFs versus miners, I think it's good to spread out, but they have very different risks, right? So there could be an environment where there's windfall taxes placed on gold miners in a similar way that you have a lot of talk about windfall taxes right now placed on energy producers, right? So they were unprofitable for many years. They weren't getting help, energy companies, and now that they're making tons of money in many cases, suddenly it's like, they want to cap their upside. And you could see a similar environment for gold royalty companies or gold miners where governments step in and want an extra cut. And so that's kind of the chief risk, in addition to just outright nationalization in some jurisdictions. So I think you have to be careful with any type of counterparty. I do like Sprott funds. I do like certain miners and royalty companies, but those are, riskier investments, obviously, compared to just holding some degree of physical metal.
I'm getting a lot of questions asking your views on silver and uranium, but predominantly silver.
Oh, so I'm bullish on both. I've been bullish on uranium since October 2020. Specifically back then, there was the Uranium Participation Corp, which is now owned by Sprott. There's Sprott Trust. Back then, it was trading at a discount to NAV. I haven't checked it lately. It's somewhere around NAV now. I'm structurally bullish on uranium over the course of this decade. Silver, I'm pretty bullish on as well. It's kind of a hybrid metal, obviously between precious metal and industrial metal. So I'm generally bullish on most metals this decade. So I'm bullish on silver, I'm bullish on copper, I'm bullish on platinum. And so I'm bullish on all of them. And I actually do like to spread out my exposure because it reduces tail risk. And so I like to hold gold, silver, platinum, uranium, and then copper producers and various copper related assets, as well as energy. I'm also bullish on just oil and gas very long term, with a caveat for industrial metals like, say, copper as well as oil. I'm concerned about potentially their performance in a recession, even though when we look beyond that, I'm structurally bullish on the vast majority of harder commodities.
Now, we have two last questions to end this presentation. One is from Jeffrey. He's asking, are oil and gas equities considered hard assets? And then the final one, many people want to know your favorite investment for 2023.
So I would consider energy producers to be hard assets. They own land or land rights. They have some degree of infrastructure buildup, and they own the rights to like commodity deposits under the earth that are scarce in some way. And so I consider them hard assets. As well as for my favorite investment in 2023. So I prefer to invest in a 3 to 5 year timeline, right? Because any 1 year is based, it can fluctuate based on all sorts of market sentiment, whereas 3 to 5 years gives fundamentals a true time frame to play out. But for 2023, as we look towards an inverted yield curve, as we look towards a probable recession or at least significant economic slowdown, I think gold is offers one of the best risk rewards for that year, because it tends to outperform other assets in a declining economic environment. So when it's very risk on, that's when you probably want to own stocks. You probably want to own things like that. Whereas in a risk off environment, generally gold is attractive. If I pick riskier assets, I've been reasonably bullish on Brazilian equities. I've been reasonably bullish on Indian equities. I'm pretty bullish on Bitcoin at these beaten down prices. So there's different things you can take on more volatile exposure to. But I think in a risk reward sense, I think gold is pretty well positioned for 2023 compared to other assets out there. There is one thing I'll add is that there was a recent data set I was looking at that shows that going back to the 60s, which is where the data goes back to, every time the yield curve inverted, the stock market generally bottomed between 1 and 2 years later. It almost never bottomed significantly before 1 year later, and it almost never bottomed significantly after 2 years later. And so, if the bottom's not in, that's actually historically pretty unusual, right? That would have meant that it bottomed really early after a yield curve inversion. And so basically what that data set was implying, and it could be different this time, but what it was implying is that we probably are going to see lower lows at some point in the stock market, especially if we do encounter an outright recession, later next year. And so I think in that environment, it's hard to say what gold would do, but I do think it would hold up better than stocks would in a recession.
Awesome. Well, that concludes our time for the session. And Lynn, Paul does want you to know that you're his hero and his guru. So we want to thank you so much for, joining us and this incredibly informative presentation. And I hope everyone watching and you have a wonderful holiday season and a happy new year.
Thank you. You as well. And everyone listening. Happy holidays.